Good morning. It is Friday, August 14th, 5:11 a.m. And here is your financial update for this morning. In news that is probably not great, the Fed's direct money transfers are coming. Brainard says Fed collaborating with MIT on hypothetical digital currency. 1 week ago, we published a remarkable interview with two former Fed economists, Simon Potter and Julia Coronado, who have tremendous impact and influence on prevailing thinking at the Federal Reserve, aka America's private corporation central bank evil place, and who minted at the Fed's last-ditch reflationary strategy, wiring digital money into Americans' financial apps, bypassing the reserve system entirely, and sparking an inflationary conflagration. As we said last Monday, the two propose creating a monetary tool that they call recession insurance bonds, which draw on some of the advances in digital payments, which will be wired instantly to Americans. And while this idea may have seemed absolutely ludicrous as recently as just 1 year ago, the fact that just as ludicrous helicopter money is now de facto policy means that direct deposits of cash by the Fed into individuals' accounts is becoming increasingly probable. The only thing missing is the digital currency that would be used by the central bank. Addressing this issue on Thursday afternoon, Federal Reserve Governor Lane Brainard hinted once again at the coming monetary revolution when she said the Fed is studying the opportunities and challenges presented by central bank digital currencies. To enhance the Federal Reserve's understanding of digital currencies, the Federal Reserve Bank of Boston is collaborating with researchers at the Massachusetts Institute of Technology in a multi-year effort to build and test a hypothetical digital currency oriented to central bank uses. The objectives of our research and experimentation across the Federal Reserve System are to assess the safety and efficiency of digital currency systems, to inform our understanding of private sector arrangements, and to give us hands-on experience to understand the opportunities and limitations of possible technologies for digital forms of central bank money. These efforts are intended to ensure that we fully understand the potential as well as the associated risks and possible unintended consequences that new technologies present in the payments arena. In prepared remarks of a speech titled simply enough, an update on digital currencies and prepared for delivery Thursday at a Fed technology event, Brainard said that a significant policy process which would be required to consider the issuance of a CBDC, along with extensive deliberations and engagement with other parts of the federal government and a broad set of other stakeholders. This punchline is important to understand how the existing provisions of the Federal Reserve Act with regard to currency issuance apply to a CBDC and whether a CBDC would have legal tender status depending on the design. The Federal Reserve has not made a decision whether to undertake such a significant policy process, as we are taking the time and effort to understand the significant implications of digital currencies and CBDCs around the world. So what would prompt the Fed to undertake this significant policy process? Why, another crisis, of course. We read with great interest a Bloomberg interview published on Saturday with two former central bank officials, Simon Potter and Julia Coronado, which I've already talked about, who spent 8 years as an economist for the Fed's Board of Governors, who are among the innovators brainstorming solutions to what has emerged as the most crucial and difficult problem facing the Fed: get money swiftly to people who need it most in a crisis. The response was striking. The two proposed creating a monetary tool. Okay, is this literally just the same part? Okay, we go down a little bit. It's like almost repeating itself here. Let's talk here. It describes it. Congress would grant the Federal Reserve an additional tool for providing support, say a % of GDP, to households in a recession. Recession insurance bonds would be a zero coupon security, a contingent asset of households that would basically lie in wait. The trigger could be reaching the zero low bound on interest rates, as economist Claudia Sham has proposed, as a 0.5 percentage point increase in the unemployment rate. The Fed would then activate the securities and deposit the funds digitally in households' apps. As Potter then elucidates, it took Congress too long to get money to people and it's too clunky. We need a separate infrastructure. The Fed could buy the bonds quickly without going to the private market. On March 15th, they could have said interest rates are now at zero. We're activating X amounts of bonds and we'll be tracking the unemployment rate. If it increases above this level, we'll buy more. The bonds will be on the asset side of the Fed's balance sheet. The digital dollar in people's accounts will be on the liability side. And that, in a nutshell, is how the Fed will stimulate the economy in the next crisis in hopes of circumventing the reserve creation process. It will use digital money apps to transfer money directly to U.S. consumers. To be sure, the narrative is already set for how the Fed will sell this direct transfer of money to the rest of the world and the broader U.S. populations. As Coronado explains, it's the most efficient from a macroeconomic standpoint in supporting spending and confidence. The fear of unemployment acts as an accelerant on recession. There's a shock, people are losing their jobs or worry about losing their jobs. They get a very risk averse. And the kicker, you could actually generate real inflation. It could be beneficial for not only avoiding negative rates, but creating a more healthy interest rate market, healthy yield curve. So there you have it. The one thing that was missing from a decade of monetary tinkering by the Fed, the spark of inflation, will finally arrive as the Fed gives money to those most likely to spend it, the lower and middle class of society. But wait, there's more. Now that the Fed is implicitly focusing on racial inequality, and soon explicitly with Joe Biden going so far as to urge the Fed to fight racial and economic inequality, and former Minneapolis Fed President Kocher Lakota writing an op-ed in which he said the Fed should have a third mandate on racial equality, the stage is now set for the Fed to specifically release funds for those who have suffered from inequality, and once the time comes when the narrative allows to deploy reparations or direct funding to minorities, the Fed will be ready. That's some scary shit, man. On one hand, you have Trump trying to get a gold standard proponent, Judy Shelton, into the Federal Reserve to take us back to sound money, proper money. And on the other hand, you have the Democrats trying to pass digital dollar bill into our stimulus packages. And look at this, just waiting for reparations to become law. Boom, free money to anyone who's not a white male, free money to everyone who is a oppressed person of color, deemed anywhere on the totem pole of bullshit and intersectionality. That's some scary shit, and they're gonna just hand this money out for free. They're not gonna have to do anything. They're just gonna push a button. It's gonna appear out of thin air into computer systems and go straight to people's bank accounts, further devaluing your dollar. That is some scary, scary stuff. And let's see. It's more like questions and answers. It's a long interview. It's on Zero Hedge. Check it out. Great, very truthful news source, zerohedge.com. Okay. In crypto news, data analyst Ethereum transaction fees will put a hard cap on the DeFi bull run. I guess DeFi is like the big, keyword or hot buzzword in the crypto market this year. It stands for decentralized finance. Ethereum's decentralized finance community and market have seen exponential growth over recent months. According to Crypto Slate sector data, all DeFi coins in circulation are now worth $12.78 billion in aggregate. This sum was closer to 3 to 4 billion just 2 months ago. Acknowledging this upward trend, analysts have said that DeFi is at the start of a parabolic growth cycle. As reported by Crypto Slate previously, Eric Connor, a prominent Ethereum proponent who works on Gnosis, commented that upwards of 50 billion could flood into the DeFi market cycle. The ghost chain reckoning is coming. There will be over 50 billion in market cap value for chains no one uses. They will all be usurped by DeFi apps with actual use by the end of this market cycle. The expectations of such growth were echoed by Andrew Kang, founder of Mechanism Capital. He said in a Twitter thread that multiple factors indicate that Ethereum's DeFi space is only in the early innings of a much bigger game of growth. Transaction fees, unfortunately, may act as a catalyst that caps the ongoing DeFi rally, according to one prominent on-chain analyst. Ethereum's transaction fee debacle could put an end to the ongoing DeFi boom. According to Jacob Franek, a co-founder of blockchain data firm Coinmetrics, high Ethereum transaction fees could be a stop to the bull run. Franek is responding to the record transaction fees currently being incurred by Ethereum users. Ethereum Gas Station reports that the cost of gas has reached 300 gwei, 3,000% higher than this metric was at the start of the year. On why these fees could prevent DeFi from rallying too far to the upside, Franek commented, gas prices will put a hard cap on this DeFi bull run. To be expected and probably a good thing, high gas, likely new normal. He is referencing how many users get crowded out, meaning they cannot invest or participate in certain Ethereum applications due to the high transaction fees. For context, 300 gwei means simply sending ETH from address to address. Takes around $2.50 while sending a token costs $5. Small-scale DeFi users are also priced entirely out of the DeFi game at 300 gwei, as it costs $10 to trade on Uniswap and $20 to do anything notable. on or with any of the top DeFi protocols. Not yet, just saying it places a natural hard cap on how far this can run. Quote, traders will only pay that much if they're performing significantly well, Franek concluded in a reply to someone who commented on his opinion. Multiple scaling solutions are on their way. While Franek and many others acknowledge the risks of high transaction fees posed to the growth of Ethereum and its respective applications, there are solutions on their way. Cool. I mean, all I can tell you is this is like bearish news for Ethereum, and the DeFi craze. But if you look at Ethereum's price last night, it went past 400 and is sitting pretty at 428 right now. That is looking really good. Bitcoin holding at 11,746. It's back up. XRP about to hit 30 cents again. Chainlink, the number 5 coin, did see a nice surge yesterday to a new all-time high-ish of $17 before slipping a tiny bit. Unbelievable. I'm kicking myself, just like in 2017. If I had bought $1,000 worth of XRP at the beginning of 2017, I'd probably be rich. If I had bought $1,000 worth of Chainlink at the beginning of 2020 or 2019 or whenever it came out, I would probably be doing quite well. It's crazy, man. Sometimes it's hard to see which ones are going to be the winners. I missed out on those, and it is what it is. No big deal, but Chainlink has become the number 5 coin. I know nothing about it. I know it's controlled by Oracle. It's an Oracle platform, and there's a lot of people that do not like it, but you cannot deny that price. Cardano, the Ethereum killer, supposedly, holding just under 14 cents. Tezos doing well, above $4, still, even after slipping a couple percentage points. Tron is up 20%. That's somewhat surprising. I mean, they've been working on it this whole time. I know that. It's just not, it's funny, you don't hear much about it anymore, but there it is as the number 15 coin. It's still in the game at up 20%. VeChain, something I still expect to do incredibly well eventually, is still now above 2 cents. It's doing not bad. IOTA is kind of coming back a little bit. I've got a friend who really loves Digibyte. That's still above 3 cents. But yeah, sadly about Basic Attention Token, I really had high hopes for this one. The man who invented JavaScript, the man who invented Mozilla Firefox and eventually got ousted from his company, if you remember that, went on to create a Google killing crypto called Basic Attention Token, which was supposed to destroy Google's ad ability, basically getting everyone off of Google platforms, especially Chrome, and onto his browser so they could be paid to watch advertisements. I don't know how that's doing, but I mean, it's not 27 cents. It should be doing a lot better, in my opinion. Anyway, okay. I am going to check out the gold prices here. Yeah, the market's open. Oh, they are opening in right now. Interesting. Gold's still kind of floating around this mid 1900s. Silver is where it's at right now with a strong price of $26.72. I mean, my goodness. It's all you silver buyers, because silver is so much easier to get into. You guys are keeping it up no matter what they throw at it, no matter what kind of false paper contracts they throw at it to try to drive the price down. It is not happening. Countries are buying these precious metals like crazy as they continue to see the U.S. government print more and more of those sweet, worthless federal notes. Which, by the way, will be a lot worse in this digital dollar stuff that we were just talking about earlier. Be very, very weary of this digital dollar. Not a good thing whatsoever. Anyhow, that is going to do it for your financial update for Friday. I should be back with one more on Saturday tomorrow and back again on Monday. Thank you so much. Have a great day.